Most investors are asking the wrong question about SpaceX's IPO. They're asking whether the stock will go up tomorrow. But the real question is this: if SpaceX is worth $1.75 trillion, why did the people closest to the company design a system that lets them start selling their shares while retail investors are still buying? Because buried inside the IPO documents is a calendar that could determine who makes money and who becomes the exit liquidity. Before you buy a single share, you need to see these dates. On June 12, 2026, SpaceX went public, and the bigger it runs in the next few weeks, the more shares get dumped on you. See, SpaceX engineered today's pop to work against you. I know that sounds dramatic, so let me earn it. Somewhere in Manhattan right now, a group of bankers is watching SpaceX trade. Every tick higher, they smile a little wider. Not because they own the stock, because there's a clause in the lockup agreement they helped write, and the higher the price goes, the sooner that clause triggers. The pop everyone's celebrating today isn't a celebration, it's a countdown. Before I go any further, let me say what this video is and what it isn't, because I want to be honest about it. This isn't a video about SpaceX being a bad company. By almost any measure, it's an extraordinary one. It launches more rockets than entire nations. Starlink alone now serves more than 10 million customers in over 150 countries. The defense contract pipeline runs deep. So if you came here looking for someone to tell you the rockets won't fly, that's not what this is. This is about something different and, in a way, more important. It's about the difference between a great company and a deal structured to favor everyone except the person buying today. Those are not the same thing, and the gap between them is exactly where ordinary investors lose money on deals like this one.
What I'm going to show you over the next few minutes lives in a public document. It's printed in the prospectus SpaceX filed with the SEC. Anyone can read it. And yet almost none of the coverage you've seen today has touched it. By the time we're done, you'll have a calendar with specific dates on it, and you'll understand why those dates matter more than the opening price on your screen right now. Before we get there, one quick anchor on price because it matters for everything that follows. SpaceX is going public at a valuation of about $1.75 trillion against last year's revenue of roughly $18.7 billion. That's somewhere near $94 of valuation for every single dollar of sales. 94 to 1 for a company that's currently losing money. To give you a sense of how stretched that is, one of the most respected independent research firms on Wall Street ran its own detailed valuation of SpaceX and concluded the company is worth closer to $780 billion. That's more than half below the price it's going public at. So when I say the deal is structured to favor everyone except the person buying today, that's not a feeling, that's a number. The valuation already assumes the future has arrived. Everything that comes after this is about who profits if it doesn't. Let me build this from the ground up, because the rest of the video depends on getting this right. When a company goes public, only a small slice of its shares actually start trading on day one. In SpaceX's case, that slice is about 5% of the company. The other 95% is still held by the people who got there first, the founders, the employees, the venture firms that funded SpaceX over the years. Those insiders aren't allowed to sell yet, they're contractually locked up. The reason is simple: if everyone who owned cheap shares could dump them on day one, the supply would crash the price instantly. So almost every big IPO uses what's called a lockup period, usually 180 days, to hold that supply back. Now, here's where SpaceX did something unusual. Instead of one cliff at the end of 180 days, the way Rivian did it, the way Uber did it, the way almost every big IPO does, SpaceX built a staggered release schedule. 5 separate trenches that unlock at fixed intervals, 2 additional cliffs tied to earnings reports, and 1 performance trigger tied to the share price itself. That last part is the one I want to spend a minute on, because it's the part the headlines aren't covering. Here's what the prospectus actually says. If SpaceX trades 30% above its IPO price for 5 out of any 10 consecutive trading days before the first earnings report fires, 10% more insider supply gets released. The IPO price is $135. 30% above that is $175.50.
So the threshold isn't theoretical. It's a specific number. And any trading day where SPCEX closes at or above $175.50 counts towards the 5 out of 10 requirement. Here's the part that should make you pause. The futures market, the place where traders have been pricing SPCEX before today, has been sitting at around $155. That's roughly a 15% pop from the IPO price already priced in, which means the trigger isn't sitting at a level the stock would have to soar to reach. The trigger is roughly 13% above where the market already expects this stock to be trading. One good week, that's all it takes. So the clause does something most retail investors will never notice. It turns the day one pop, the thing everyone on financial Twitter is celebrating right now, into the starting gun for early insider selling. The harder the stock runs in the first few weeks, the faster 10% of locked-up insider shares become free to sell. The pop isn't a victory lap, it's the trigger. That's the clause. That's the mechanism. Now let me show you the calendar. I want you to picture a calendar pinned to a wall. Today, June 12th, is day 0. SpaceX is now publicly traded. About 5% of the company is in the float, and 95% is locked up. Now let's walk forward. Friday, August 21st. That's day 70. The first of 5 staggered tranches unlocks. 7% of insider shares become eligible for sale. Thursday, September 10th, day 90. Second tranche, another 7%. Friday, September 25th, day 105. Third tranche, 7%. Saturday, October 10th, settled on the following trading day, day 120, fourth tranche, 7%. Sunday, October 25th, settled on the following trading day, day 135, fifth tranche, 7%. That's 35% of insider shares released across 5 dates between late August and late October. And those are just the time-based unlocks. 2 more cliffs land somewhere in between them, tied to the company's earnings reports. The first cliff fires 2 days after SpaceX reports its first quarterly earnings as a public company. That's the quarter ending June 30th. The earnings release itself can land anywhere from mid-July to late September, depending on how the company decides to schedule its first call. Whenever it lands, 2 days later, an additional 20% of insider shares unlocks. That's bigger than any single staggered tranche, and the exact date isn't fixed in advance, which means the moment it actually arrives is something most retail buyers won't be tracking. The second cliff is even bigger. 2 days after the Q3 earnings report, quarter ending September 30th, earnings typically released between mid-October and late December, another 28% unlocks. Then comes Wednesday, December 9th, day 180, the standard lockup expiration date. Every restriction that hasn't already lifted lifts now. Whatever's left of the insider supply is free to trade. Add it all up, and the math closes cleanly. 5 staggered tranches at 7% each is 35. The Q2 cliff is 20. The Q3 cliff is 28. That's 83% of insider shares released before the calendar even hits day 180. The final 17% unlocks at the standard expiration. By mid-December, 6 months from today, every restriction on the staggered schedule has lifted. 6 months. That's the timeline you should be thinking about, not whatever the stock does in the first hour of trading. And there's one more date worth marking. Sunday, June 13th, 2027, day 366. That's when Elon Musk's lockup ends. We'll come back to why that date matters, because it changes the whole picture once you see it. So here's the question. Why would SpaceX design a lockup like this? Why not just use the standard 180-day cliff that every other big IPO uses? The answer is that this schedule was built to do 3 specific things, and once you see what they are, the design stops looking neutral and starts looking deliberate. The first thing it does is avoid the cliff drop. When Rivian's lockup expired, the stock dropped about 20% in a single day after Ford disclosed it would sell its stake. When Uber's lockup expired, the stock hit an all-time low on the expiration date.
When Palantir's expired, the stock fell 13% in a single session as Peter Thiel and other insiders sold tens of millions of shares. Cliffs are brutal. Cliffs are visible. Cliffs make headlines. A staggered schedule diffuses that pressure across a dozen smaller dates that nobody outside the prospectus is going to track. The second thing it does is accelerate float growth. Remember that day one float of around 5%? The faster that number climbs, the higher SpaceX qualifies to be weighted in major stock market indexes, especially the NASDAQ 100. Under a new rule that took effect just before this IPO, companies can be added to the NASDAQ 100 in as little as 15 trading days after listing, instead of the 3 months that used to be required. And the rule comes with a multiplier most people have never heard of. For companies with a free float below 20%, the index treats their float as if it were 3 times bigger than it actually is. SpaceX's 5% gets weighted as if it were 15. That means a tiny sliver of trading shares pulls a much bigger gravitational weight in the index than the math should normally allow. And the heavier the weighting, the more forced buying pours in from every passive fund that tracks the NASDAQ 100. And there's well over $600 billion in funds doing exactly that. So every tranche that unlocks isn't just releasing supply for insiders to sell, it's also clearing the path for institutional buying to flood in on rules that were rewritten just months ago. That's not an accident, that's a feature. And the third thing it does is the part nobody is saying out loud. It gives insiders predictable exit windows on dates they can read in the prospectus today. Day 70, day 90, day 105, day 120, day 135. 2 earnings cliffs sometime in between.
The performance trigger sitting on top. None of these are secret. They're all public. They're just buried in 150 pages of legal language most retail buyers never open. The asymmetry isn't about access to information, it's about who reads it. None of this is illegal, none of it is even unusual for a deal of this size. It's just engineered, and the people who engineered it didn't engineer it for you. I know I'm asking you to take a lot on faith here, so let me anchor this in something concrete. What's actually happened to other companies when their lockups expired? Palantir went public in September of 2020. Retail enthusiasm pushed the stock from around $10 at listing to levels near $40 by early 2021. Then the lockup expired. Insiders, including Peter Thiel, sold tens of millions of shares into the premium that retail had built. The stock fell 13% in a single session and spent months recovering from it. The expiration date itself was printed in the prospectus from day one. Almost nobody buying at $38 was tracking it. Rivian went public in November of 2021. The opening day was one of the most exciting in recent memory. The stock jumped 22% above its IPO price, and a lot of buyers took that pop as proof they needed to get in fast. 6 months later, the 180-day lockup expired. Ford disclosed it would sell its entire stake. The stock dropped about 20% in a single day. Over the year that followed, it fell 67% from where it had peaked. Every one of those dates was visible to anyone who looked. Uber went public in May of 2019 at $45 a share. By the time its lockup expired in November of that year, the stock had been struggling, and on the very day insiders were finally allowed to sell, it hit an all-time low. The price sat 40% below the IPO price on the expiration date itself. The headline writers framed it as a coincidence. It wasn't. Even Snowflake, which used a staggered schedule, the closest analog to what SpaceX is doing, wasn't immune. The final expiration week alone dragged the stock down about 11%. The pattern across all of these is clean. The higher the speculative premium at the IPO, the more painful the expiration tends to be. SpaceX is going public at roughly 94 times last year's revenue. That's the highest premium of any major IPO in years. By that measure, the room for things to get rough on expiration day is unusually wide. None of those 4 companies were bad businesses. Most of them are still around. Some have recovered.
The point isn't that SpaceX is going to collapse. The point is that the part of the deal that hurt retail investors in every one of those names, the unlock, is the part that's still ahead of us in this one. So let me come back to that date I mentioned earlier. June 13th, 2027, day 366. The day Elon Musk's lockup ends. Musk holds the majority of voting power in SpaceX. He's the founder, the public face, the entire story in a lot of ways. And in the prospectus, he committed to a 366-day lockup. He cannot sell a single share for a full year, not at day 70, not at day 90, not at the Q2 cliff, not at the Q3 cliff, not at the 180-day expiration, not even if the performance trigger fires. He's locked out of all of it. Every headline you'll read tomorrow will call that a positive signal. And on its own terms, fair enough. The founder isn't dumping shares on day one. That matters. But here's the part that doesn't show up in those headlines. Every other insider, the early employees, the early venture firms, the executives below the very top tier, is on the schedule we just walked through. Their first chance to sell starts somewhere in the next 90 days. By the time Musk's lockup even begins to lift, the rest of the insiders have had a full year of unlock windows to cash out into retail demand. A full year of opportunities for the people who got there first to sell to the people who got there last. The person at the top is protected. The people in the middle get multiple exit doors over the next 6 months. The person buying tomorrow on their phone, watching the ticker climb, is the demand all those exits are pointed at. The whole structure makes a lot more sense once you see it from above. Musk doesn't need to sell in the next year. He holds majority voting power. His net worth doesn't depend on liquidity, and a public lockup signals confidence. The early employees and venture firms do need to sell. They've been waiting years to convert paper gains into actual money, and they have lockup partners, fund timelines, and clients waiting on returns. So the deal lines up nicely for both groups. The founder gets the credit for staying locked. Everyone else gets the timing windows to cash out. The only people the structure doesn't line up for are the ones absorbing all of it. Same prospectus, same company, two completely different deals depending on which side of the lockup you're on. So, where does that leave you if you're genuinely drawn to this company? Because watching everything I just laid out is not the same thing as saying you should never touch SpaceX. There's a smarter path than the two loud options. The first loud option is to chase the hype. Buy today at the popped price right before the trigger window opens and the staggered trenches start unlocking. We've now seen step by step why that's the weakest seat in the house. The second loud option is to write off the whole thing forever on principle, which throws out a genuinely remarkable business because the deal structure was unfair on day one. The third path is quieter, and it costs you nothing but patience.